Ever wondered what the Federal Open Market Committee, or FOMC, really does? Or how the federal funds rate is determined? Well, you're in the right place. Let's dive right in. The FOMC, or Federal Open Market Committee, is the monetary policy-making body of the Federal Reserve System in the United States. It's the committee responsible for setting the nation's monetary policy, including decisions on interest rates and money supply. During FOMC meetings, members discuss and release economic projections. These forecasts cover everything from economic growth and inflation to unemployment and interest rates. Then comes the statement. The FOMC releases a document outlining their decisions on monetary policy, including any changes to interest rates or policy outlook. The FOMC chair then holds a press conference to provide further insights into the committee's decisions and answer questions from the media. The FOMC's decisions aren't just words on paper. They have significant implications for the economy. Changes in interest rates and monetary policy can influence borrowing costs, investment decisions, and economic activity. Now, let's shift gears to the federal funds rate. This is the interest rate at which banks lend reserves to each other overnight, set by the Federal Reserve. Changes in the federal funds rate can influence borrowing costs for consumers and businesses, affecting spending and investment decisions. For forex traders, shifts in the federal funds rate can have significant implications. An increase in the rate can lead to higher borrowing costs, potentially slowing down economic activity and curbing inflationary pressures. On the flip side, a decrease in the federal funds rate can stimulate economic growth by lowering borrowing costs, encouraging consumer spending, and potentially increasing inflationary pressures. In conclusion, changes in the federal funds rate not only affect borrowing costs and economic activity, but also play a crucial role in shaping inflationary trends in the U.S. economy. But what happens to the native currency when the results of the federal funds rate are higher than expected? When the Federal Reserve announces a higher than expected federal funds rate, it typically signals tighter monetary policy, which can lead to an immediate strengthening of the currency. Forex traders may interpret the higher interest rate as a sign of a stronger economy and better investment opportunities in the U.S., causing demand for the U.S. dollar to increase and the U.S. dollar index to rise. In summary, when the results of the federal funds rate are higher than expected, it often leads to a strengthening of the U.S. dollar as investors anticipate tighter monetary policy and better investment opportunities in the U.S.